If you are a founder of a startup, you may think that recognizing revenue is quite straightforward, but unfortunately, it isn't as straightforward in a lot of circumstances, actually. So, understanding when you should be recognizing revenue is something you do need to think about. It is easier to get wrong than you think. So, today I wanted to go through what you need to consider when you're recognizing revenue. If you are running a startup, especially SaaS, e-commerce, anything with upfront payments or rather than transactional payments like a e-commerce retail store, there's subscriptions, delayed delivery, then this video is really important for you. Recognizing revenue properly it's not just a finance technicality, unfortunately. It does directly affect how healthy your growth looks and how much tax you owe, how much an investor trusts your numbers, which is really important when you're thinking about revenue recognition and how your startup is going to present to the world. My name's Alysha Randall. I'm a fractional CFO, but I'm also a founder of Fast Growth Consulting. We work with early stage startups to prepare them both for investment, but also to help founders maximize their growth and minimize their risk. So again, revenue recognition, what is it basically? So it means when your business officially counts the money as earned income, not just when it's received. So if I'm thinking about financial statements, it's when the revenue number goes up. So it's when a transaction is in your P&L, your profit and loss statement or your income statement, and it's when you can say, oh, this is our revenue for a given period. So it's not when cash is received, it's when you recognize that revenue. So unfortunately, just because a customer pays you, that doesn't mean that that cash is not necessarily revenue straight away. And I'll go through a few examples. Okay, so here I've just set up a mini table just to demonstrate it quite easily. Subscription revenue is probably the easiest one to explain, but it doesn't necessarily mean it's a subscription business. It could be retail, it could be any other type of B2B, B2C situation. So let's say, for example, you have a SaaS business. It costs £12,000 for a customer to get access to your software for 12 months. And most of the time, a customer or a subscriber would pay you $12,000 upfront, and then they have access for the next 12 months. So from a cash perspective, we're ignoring VAT, GST, sales tax. From a cash perspective, you will receive £12,000. We recognize the revenue over the full 12 months. And there is a few reasons for that. The first one is that you are not delivering. So when the customer pays £12,000 in month one, they're not getting the full subscription in month one. They're not paying £12,000 every single month. They are getting access for a full 12 months. And therefore, you are delivering a product for the full 12 months. It is they're getting £1,000 benefit every single month. Let's ignore refund and cancellation clauses in the contract, but if, say, for example, they decided to cancel in month 4 and you have to refund them £9,000, you quite rightly should have only recognized 3 months worth of revenue, which is £3,000, and then refund them £9,000 because they've only received the benefit of the £3,000. Another reason is because the costs associated with delivering your product will be for the full 12 months as well. So whatever it is, let's just say the cost to deliver, it may be some platform fees that you have to incur. It may be your customer services team. They're not going to do all of the 12-month work in the month one. They are going to do the work over the full 12 months. So say, for example, your customer services team costs £50 per month per client. So you will need to incur £50 per month per client. and obviously I'm just making stuff up, let's just say it costs you another £100 to deliver the product. Largely they're probably paying for the IP, but you probably still have some small kind of costs associated with it. So if you had your revenue like this, as it should be, you would have a consistent profitability across the entire year. So here we have got our total revenue minus the costs to deliver this product, and we get a profitability of £850. From a margin perspective, that is 85%. So usually with SaaS businesses, the margins are quite high. Now, if you recognize your revenue like this, then your total profitability will be all over the place because you've got 12,000 there. So you're going to make a good amount of profitability in month one. But then for the rest of the time, you're going to actually be making a loss of £150, and your margins, again, will be all over the place because here you've got a 99% margin, and then for the rest of it, it's actually negative. It looks like a div because it doesn't like it, but essentially it's a negative. So it'll be negative loads of percent. So when you are trying to work out as a founder, so this is not thinking about accounting technicalities. I'm thinking about it as how you can run your business. So if you're looking at this as a founder, you can quite clearly say, okay, I have made, of the products that we have sold for this financial year, we have made a profit of £850 each month and 85% profitability on the product. And when you're adding different revenues, you're adding customers, you're adding products, you can see how it's easy to manage, and it's clearly telling you how profitable your company is. If you're doing it like this, it is very difficult to work out how profitable your company is or isn't. And particularly when you've got these negatives, particularly if you have multiple different customers buying at different times and multiple different products, because you may have a situation where your revenues and your margins are so up and down that you cannot for the life of you say whether you're profitable or not. So if you have a situation like this, you need to speak to your accountant and get them to rectify the revenue recognition policy. So ideally, for this one client, your revenue should be looking like this if you're delivering it over a 12-month period, rather than this, again, if you're delivering it over a 12-month period. The other reason, apart from the fact that it's difficult to run a business like this, is that this is the version that investors will expect you, boards will expect you to be reporting. If you're reporting like this, the investors won't trust your numbers, and there's a good chance that you're not going to get what you want. They can either walk away from the deal, or your valuation will be lower because they know that you need to invest in a proper finance function. So this is another reason why it's incredibly important. Some other common mistakes are, as we said, the upfront billing of a 12-month period. So you can see you had that spike of cash and then that flat revenue. The second one is events. So sometimes goods or services will be prepaid but not delivered. And the accounting standards say you can't recognize revenue until it's been delivered. So if it's just one event, so this is different from, say, a subscription, just one event, then your revenue basically needs to wait. You can't recognize that revenue until you have delivered the product or service. The third one then is physical products. So again, orders have been placed but not yet dispatched. If they haven't been dispatched, they're not earned. So if people have paid for you for a product, there's a delay in delivery for some reason, whether it's problems with your manufacturer, problems with customs, problem with shipping, you can't recognize that revenue until the customer has received, or it's been dispatched and the customer is soon to receive the products that you've been sending. And a fourth common problem is long-term services. So milestone payments may need to be spread out over the delivery. So if you do long-term services and there's certain points in the project that they will make payment, you need to look at the full project and recognize the revenue over the life of that project, depending on the contractual terms. So again, why does this matter? Investors will really dig into this, so they will absolutely want to understand what your revenue recognition policy is. So regardless of what stage you are, whether you're seed, even earlier than that, Series A, whatever, if you are earning revenue, investors want to know what your revenue recognition policy is. You just need to have an agreement or an understanding of what it is. The entire company, your commercial team, sales team, and your finance team, or if it's just your bookkeepers, need to understand what that revenue recognition policy is, and therefore everyone needs to adhere to that. There's also tax implications. So if you are overstating your revenue, you are potentially overstating your profit. So in the last example that I showed you in Excel, say, for example, your year end is at the end of month 2. You're going to be recognizing that full £12,000 revenue, even though you haven't incurred all of the costs yet. The costs are still yet to come. So you're going to have to pay corporation tax on that profit, even though the costs haven't been fully matched up. So this is a risk that you also have. The cash versus profit mismatch, the timing of the way that you recognize things, and understanding your cash and your profit is really important. I would say as a founder, cash is obviously the most important, but the second most important is profit, and they do work together. It's not one or the other. And then, as I mentioned, you really damage your trust in diligence. So if you are preparing to get some investment, the numbers will be distrusted if your revenue recognition is all over the place. So how are you going to fix that? So the first thing is understanding the flow. So even if it, again, just using Excel or typing something out in whatever it is, the flow of when an order is made, when is it delivered, when is the liability as far as you are concerned ends, when is the cash payments made, when is it invoiced. Just understanding that flow, even just on a timeline, is really useful. So use kind of a revenue schedule so you can see the differences of cash and revenue. When you're thinking about it, also consider when is it cash and when is it revenue. So cash is very transactional. It's very easy to understand. Revenue is basically when you have delivered what you're obligated to deliver. When is the customer happy? You've done what you said you would do. They have paid for the product or the service that you have done. It's like the end of your engagement. So trying to think about it from that perspective will help you being able to separate the difference between cash and revenue. And then obviously you want to make sure that your financial reporting reflects this. So you want to make sure that your bookkeepers and your accountants and your management accounts and your budgeting has that £1,000 every single month in the subscription example, rather than having the 12,000 in your income statement. So just make sure that you work out what it should be and then work towards making that transition if it's different. It can be a bit complicated, I'm not going to lie. So sometimes it can be a real head scratcher, and there's certainly been situations where we've almost had like a whiteboard session with founders trying to work through what is the best way of recognizing the revenue. The accounting standards are quite clear, but obviously sometimes there is a bit of a nuance. So if it gets a bit complicated, you may want to speak to somebody like us at Fast Growth Consulting to help with that decision process. We do have a 3-month program that helps founders fix and prepare for a fundraise or fix their finances to prepare them to help understand their business profitability a bit better. If this is something that you're interested in, then just click on the links below and reach out. So you do need to sort out revenue recognition. It is a really important part of financial due diligence within your business. If you're a founder, you don't need to be an accounting expert, but you do need to understand the basics, which I have gone through in this video. Your growth story does depend on it. Your investors will expect it, and your financials will look a lot healthier when the numbers really reflect this reality. So this is one of the first things we fix with our clients. If you are interested in working out whether you're investor ready or not, would you have a free scorecard? It's 10 questions, it'll take you about 3 minutes. We'll leave a link below for that. And then once you get your results, we give you some free resources that you can work on the back of that to get you more investor ready than where you are today. So check that out as well. Otherwise, click on the subscribe button, drop any comments if you have any questions, and I'll see you in the next video. Cheers.